I also wonder, where is it that you would go hunting for value in this market? Because growth has rallied and the reopening plays have also moved higher. Value is picked up. And so what part of the market looks undervalued?
So we still think there are values to be held here inside of the U.S., whether it's the blue chip battleship balance sheets, either on the growth or value side of the ledger. You have to be highly selective, but you certainly can look to, say, China if you're a long-term growth investor. Clearly disconnected from our market's rebound this year. Certainly many headwinds and some self-inflicted wounds going on inside of that economy and that market, but nevertheless, for long-term investors, we think that's, for a small percentage of one's portfolio, probably a good place to at least begin to look. Europe, which really is a basket case in terms of economic activity overall, has many selective opportunities. So in the hands of a good active manager who knows how to hunt for rubies in the rubble, we think Europe would be a wise choice. And then in the underrepresented, underanalyzed small and mid caps, both domestically and globally, so long as you're in an actively managed fund where the manager's track record is easy for you to gauge in terms of their success, there too, I think you'll be able to find some bargains.
Okay, you're also talking about how China's market wounds could be favorable for long-term investors. What if the scars run deep?
Well, that's the big question. Just how much China itself will put up with the kind of self-inflicted wounds it's been inflicting, not just in the tech sector, and really in terms of the overall economy, questions concerning the real estate bubble and the extent to which that could really thwart economic growth there. That said, we think that long-term, China, the world's second largest superpower, second largest economy, is hard to overlook and effectively impossible not to invest in, given that even your electric toothbrush probably has some component made in China. So you want to be careful, you want to be smart, you want to understand that even if you don't own a Chinese stock outright, you have exposure to what's going on inside of China. And of course, this year we've learned that what happens inside of China doesn't stay inside of China. So we're very cognizant of the risks. But as long-term investors, we can afford to be cautious and patient. And we think that 10 years from now, bets will begin to pay off. If that is, China continues to want to advance at least their concept of a free market.
Indeed. I want to get your thoughts in on the energy story. And would you still continue to ride the wave with some of the key big energy players that are benefiting from the rise in oil prices? And do you expect prices of oil, gas, natural gas, that is, will continue to move up?
Certainly, we think price volatility is going to be consistent. And heading into the winter months here, we would expect fuel oil prices relating to heating one's home to be quite volatile. Overall, we think the energy sector is one where you'd want to be maybe neutral or underweight. It's simply, from our perspective, too volatile on a year-over-year basis to want to get invested in any sort of overweight manner. On the flip side of energy, which has been having a terrific year, you could look at healthcare, which has been lackluster, but its long-term track record in terms of risk-adjusted results is stellar. So we think that's a sector that is currently a little bit undervalued in a marketplace that, on the whole, looks fairly overvalued.